back, and over to you.
Hi, everyone. And just to confirm, you can hear me and you can see the screen, right? Perfect.
Yeah.
Okay. So today's session is all about talking about how the venture capital, well, how the financing behind VC works and how that influences decision-making in VC. I've brought a couple of slides. The idea is that we want to answer the following questions. So a combination around what is the, how do VCs set targets? Where do they get their money from? How do they structure themselves? What does a fund life cycle look like? And then we're going to talk a little bit about how it actually works for VCs to eventually make money, and what that means in terms of decision making. And as last time, I'd like to keep the session interactive. So if you have any questions, just ask them, and then we can probably discuss them as we go along. My background, from last time. I just on this note, I spent 2 years at a fund called Wellington Partners, investing in seed and Series A startups, and I was kind of a little bit part of the fundraising effort for our fund at the time. And I think the interesting part for my experience at Wellington Partners was that the previous fund that they had raised was I think 350 million, roughly that kind of size fund. So an incredibly large fund, even for European, especially for European circumstances. And then the fund that I was investing from was a much smaller, around I think 50 million seed fund. So the dynamic difference in what you do when you're investing from a multi-$100 million fund versus a tens of millions fund is very different. And we're going to talk about this in more detail later. So I want to start by kind of zooming out a little bit and asking the question, what is VC actually? And I think the first part is that VC obviously is a subset of, it's an investing, it's a way to invest money. And if you zoom out to the very big picture, you have stock that you can buy in the stock market, you have real estate, and you have alternative investment, such as private equity and VC. And within that subset of alternative investments, which I think also includes hedge funds, so kind of weird things that most normal people do not put their private money in. And it's usually reserved for specialists who really know what they're doing. And those specialists sometimes say that they want to invest in this category called private equity, which is owning shares in businesses that are not sold on a public flexible market, but rather in a private setting where you don't really know the accurate price for something. You can't just sell it tomorrow. You really have to find a buyer for your shares in a particular business. And then within that private equity, you have, of course, venture capital, and then corporate venture capital kind of being an even smaller subset of that venture capital world. And I think one other interesting way to look at venture capital, in broadly speaking, is that, of course, it is equity versus debt. So as you know, investing in a company, you can either loan the money and ask for an interest to be paid back to you as an investor. That would be a debt investor, a loan, bank loan, bonds. And then on the other side, you have equity, where you as an investor essentially buy shares in the business. You own a part of the business, which means if the business does really well, you get a lot of value from the increase in the value of your shares, because you're not getting a regular interest payment. And of course, on the venture capital side, also it's usually a high risk decision versus private equity, which is a little bit more of a lower risk, more predictable revenues, etc. decision. So the basic idea of this slide is just to show that venture capital is very risky, and it takes a real share in the business rather than just loaning money to people and expecting a steady return of income in terms of interest fees. The definition of VC, this is copy paste from Wikipedia. It's the type of private equity. So as we've seen in the previous slide, it's a subset of private equity. And within that, the idea is to provide financing to small early stage emerging firms. So here you see that it's all about small and early stage in the beginning. And the idea also is that these firms have a super high growth potential. Now, I think so far so good, that's all kind of pretty obvious. Let's look a little bit more in detail why. Yeah, here the title of the slide is the VC returns are enabled by the increase of the startup valuation. And I've copy pasted a curve from CB Insights on how the Lyft, so the Uber competitor ride hailing valuation has changed over time. And I think it's pretty interesting to see how in the beginning it was, growing really slowly. And then towards the end, the valuation just skyrocketed. And, the idea is that VCs make money by this kind of, you could call it hockey stick or really exponential increase in valuation over time. And why is that? Well, it's because VCs invest about 15 to 25% in a business, and they then, wait and pray that it goes well. And ideally, they also support the founders in that period of time. And the idea is that the valuation of the business of their stake increases quickly over time, and the VCs reinvest in subsequent financing rounds to reduce the amount of dilution for them. And then in the end, they have a bigger amount of money in terms of the value of their shares that they sell to either bigger investors or an IPO. So let's look at these technical terms in a little bit more detail. So the idea is that initially, on the right, we have a exemplary startup journey that starts with an angel round, then continues with a seed round, seed plus round, Series A round, Series B round. And the gray bar is the valuation. So here the idea is that at the angel round, the valuation is, I don't know, maybe $100K. And then in the seed round, it's $5 million. And at the Series B round, it's an exemplary 60 million valuation. And the idea is that the venture capital fund, as we said, it's an equity investor, so they buy an actual piece of the business. So this example, seed investor invests 16% of the seed round. And 1 second. So 16% of that 5 million seed round is $800,000. So at the seed round, they invest $800,000 in return for 16% of the business. After that round, they own 16% of the business. And then they invest more in maybe the seed plus round or in the Series A round. And at the Series B round, they have 11%. Well, why don't they have 16% anymore, you will ask. And of course, the answer is that because they're not reinvesting their pro rata share in each round, their percentage share goes down. VCs typically are set up in a way that they make an initial investment and then continue to reinvest if a company does well. So I don't exactly remember the example here between the 16 and the 15%. If you think about it, you could reverse engineer whether or not the VC has invested there by comparing the valuation increase between the seed and the seed plus round and the decrease in value and decrease in ownership. But the main idea of this chart is to show that the VCs, if they have more money in their fund, they could choose to reinvest in a later round where the valuation is higher to minimize the reduction in their percentage of ownership. And then what happens is that over time, the investor that started off by owning 16% in the seed round owns 11% at the B round. And even though they own less in the business, in this case, it's almost, 30, 40% less, their stake is worth not $800,000 anymore, but now 6.6 million. So reflecting an approximate 10x value increase. And I don't know if every one of you watched the video where the lady was drawing a nice chart on how what kind of multiples you need to make money. You can see that in this example, they lose about 30–40% of their ownership just by dilution. And this would not even be a 10x return. Yeah? Just to put these numbers into relation. So this is the basic way how VC invests money. And of course, the idea is that at the end, you find a buyer for your shares and you sell those either to a bigger investor. It could be a private equity investor, or it could be, if you are an angel investor, you could be selling your shares in what's called a secondary transaction to a bigger Series B or growth investor. Just to quickly differentiate here, a secondary transaction, sometimes people talk about doing a secondary. That's when early stage investors or the founders are selling their shares to another investor later on. And the difference between secondary and primary is that primary transaction means the money that gets invested by an investor gets put into the business to, you know, grow, to hire more people, to invest in actually doing stuff. Whereas a secondary transaction means that you're just paying off earlier investors, but no new money gets added into the business. So that's why it usually takes a while until the business is quite large and the investment amounts are so big that the business, the startup, doesn't need all the money to take it to do stuff with. And instead they can take some of the investor interest and take that money and give it to early stage investors to cash out, so to speak. I'm just looking here in the question. There's no questions so far, so I'm going to continue for now, but please do raise your hand or post questions if anything's unclear so far. So if we continue a little bit here, the J-curve is this concept that it's kind of a similar concept as the valuation increase of the lift chart that I showed previously. And the J-curve basically says that you could either call it the net cash flows of the business. So the green line here actually dips to negative and then slowly goes to the zero line and becomes positive over time. And that kind of obviously reflects the reality of early stage startups. Yeah, you start by consuming cash initially, and the gray curve of how much money the business spits out or generates is negative, and you have to invest money. You take that money from investors, and then over time, as the company becomes more mature, the startup becomes a scale up, and then eventually a proper organization, a big company. The money that the business returns goes from negative to zero to positive, and of course, eventually the idea is to generate returns for everyone as a dividend or any other way. And the idea here is that the venture capital category of investors really focuses on the early part, and that goes between where the companies are losing money to where they are a little bit more attractive. And the second idea here is that the organizational value, which is the black line over the green line, that never goes below zero, because as you know, a startup that is losing money still has the positive valuation for investors. So the question, I guess, is how quickly does the black line go up based on how steep the green line goes up? Yeah? So of course the green line will be negative in the beginning, but then as the startup becomes more advanced and ideally becomes profitable, the green line goes up very steeply, and then the valuation has already either reflected that future value, or it is then kind of increasing further to show the value of the business. And because of that J-curve, because in the beginning you have negative cash flows in the business and you're just consuming cash as a founder, it is really risky, because a business that is just consuming money and not returning money, well, I mean, nobody knows if it will ever return money. And that is why the startup investors need to make a lot of bets to say, well, we invest in several companies that are actually just consuming cash, but we believe that we are so intelligent and smart and maybe a little bit lucky that we'll find a few companies that will eventually be returning a lot of cash. And kind of that, prediction of how well that will work out is ultimately the job of the investor. And if you also remember in this video, the last point that they talked about is that this means that you need to have a large portfolio, because you're really hoping for something that is almost unlikely to happen as an investor. You're hoping that this one investment that you make out of a few becomes incredibly valuable and works incredibly well. Kind of the combination of the how well your investment portfolio partially dies or survives compared with how well the winners in your portfolio grow, that is ultimately the return that you as a VC investor can provide to your investors. So let's maybe zoom a little bit out again and look at the history of VC to understand a little bit better what's going on in that category of investors. So it started in the 60s in the US, of course, out of all places. And the first VC was this company called, and I need to look in my speaker notes here, because this is some terms that are not known anymore today. So the first VC was the American Research and Development Corporation, ARDC, launched by a guy called Georges Doriot in 1946. And the cool thing is that he invested in a company called DEC, and that is called Digital Equipment Corporates. So I think they're making like little phones and stuff like that. And he invested $70,000 in 1957 into this company. And 9 years later, they went public. So IPO means initial public offering, and to go public means that until then a company was private, meaning that they had shares that were only sold and transacted between private professionals. And when they go public, that means that they are using a framework like the SEC in the US, or a regulatory framework in any market, where they list their shares on the stock market with all that rules and regulation. And at that point, the public, a retail investor like everyone on this call, could be buying those shares. And so at that moment, when they turned and sold those shares to the public, the investment was worth $37 million. And so you can calculate that this is about a 500 multiple of 500x on that investment. And if you calculate that if you're investing something over 9 years and it gives you a 528x return, the internal rate of return is about 101%. So that's the annual kind of average increase in value of that investment. And then, because that worked out well, there was the venture capital firm Venrock Associates. I think they might still be around today. It's part of the Rockefeller family, and they did their first investment in a company called Fairchild Semiconductor. There's this movie on Netflix about VCs and the history of VCs, so it's a lot about more info in that. And then finally, the first fund that is really famous today, Sequoia, was started by Don Valentine in 1972. And I mean, you probably need to update the number of IPOs and exits that they had by now. But yeah, everyone knows Sequoia. And I think it's really impressive to think that they've been around for quite a long time now. And I think interestingly enough, so as you can see, initially the VC category was a pretty experimental kind of information technology focused area. And I think one interesting takeaway from this is that why did people not do VC investments earlier? And I think if you look at the pictures on the right on the slide, you see that it's really all about information technology that is enabling those kind of returns. Yeah, with real estate or with medical, like making vaccines. Maybe this year is different, but normally making vaccines is not such a high return business that it attracts this type of category of investors. But when information technology first became a bit more sort of a thing, suddenly this investment type started to work. Yeah. Then in 1979, there was this thing called the ERISA, which made it possible for pension funds to invest in venture capital. And that again was a bit of a game changer, because then suddenly all these institutions that previously could not invest in venture capital because it's too risky, could start to allocate some of their percentage of their endowments into this, what was then still a new asset class. And so today, these numbers are kind of estimations of stuff that one hears. So, if anyone has completely conflicting views, please let's share and discuss. But my understanding is that a big investment fund from a university or a pension fund or just anyone with hundreds of millions or billions of dollars, they will typically invest about 3% into this alternative asset class that combines private equity and venture capital. And for that asset class, people would typically expect a 12% IRR. Yeah? So I think the expectation, and again, these numbers are, you can Google and probably find 25 different numbers, but the stuff that I heard was that an investor that puts money into venture capital would typically expect around 12% internal rate of return per year. Now, who are these people that are putting money into venture capital funds? It's typically pension funds. And again, why pension funds? So the pension fund logic is that they're taking in regular payments from the people that need to receive a pension. And the only thing that the pension fund knows is that in 20, 30 years or whatever, they need to be paying out those payments. And it's not enough to put them on a bank and ask for a normal bank interest rate, because the banks do not have the interest rates are too low. And so the idea is that you put your money into a mixed bag of investments, some stocks on the stock market, some probably commodities, some real estate, but also, as I said, about 3% get put into these alternative and slightly crazy asset classes. And so some of that hundreds of billions of dollars of pension money that is floating around and kind of waiting to be given out to people in 10, 20, 30 years from now, some of that money ends up being in the VC pockets, which then end up hopefully in your pockets. And I'm not sure actually if this number is correct, that half of the money for VC investors comes from pension funds and the other half comes from endowments, foundations, insurance companies, high net worth individuals. But I think it sounds like approximately right that the majority of limited partners, and that's the investors in the VC fund, is coming from pension funds, and the other half approximately from those. In recent years, there have also been quite a few funds that are really, really proud on having a founder investor base. So these high net worth individuals could be successful previous tech founders that can then also not just be sending money, but also maybe helping out with introductions, etc. In Europe, actually one of the biggest LPs, limited partners, investors in VC funds is the European Investment Fund. And to my understanding, that's a government entity that is basically spending taxpayers' money to, foster innovation in Europe. So, everyone who is against big government and doesn't like to pay taxes, but likes to run a startup should keep in mind that probably some of the more well-known VC funds in Europe all receive taxpayer money via this European Investment Fund. And then you can see here the amount of money under management has sharply increased in the sort of late 90s. And this is a US VC only view. And I think the interesting thing here is, of course, what happened in the late 90s. Well, the first dot-com bubble, so kind of the first real excitement about mass market, consumer technology, internet, people buying stuff on the internet, people consuming on the internet. And I think the chart, if you go further to the right, actually drops a little bit because the 2008-2009 financial crisis made it harder for investors to put money into venture capital. And the reason here is that if you are a institutional investor, like the one that we described, the pension fund, and you have $100 billion to invest, you will say, okay, I'm going to put 3% into venture capital and private equity. That means you probably put 1 billion, or let's say 500 million in, let's say 1 billion, 1% of your 100 billion fund into VC. And then what happens is if you have a stock market crash like you did in 2008, 2009, your portfolio of stocks reduces a little bit, which means that if you have, let's say 50% of your 100 billion in stocks, 50 billion in stock. If that reduces by 20%, that means your 50 billion of stock allocation goes to 40 billion, which means your overall cake of 100 billion isn't 100 billion anymore, but 90 billion, yeah, because we lost 10 billion in value in the stock market. What that means also is that we cannot be investing 1 billion in VC anymore, because we can only invest by the rules from our investment thesis, only 1% in VC. So the VC world was all okay. Everyone was making great investments and doing well, but just because the overall investment pool of that fund goes from 100 billion to 90 billion, because the stocks lose in value, that means the 1 billion of VC allocation also needs to go down to 900 million. And that of course means that maybe one new VC will not receive the 100 million from their pension fund, because the pension fund doesn't have any more allocation. And that is also, I guess, usually what's kind of driving a little bit the discussion on, can VCs raise money right now? So not founders, but can venture capitalists raise money from their limited partners? And that is usually, or not always, but often also connected to, well, first of all, what are the interest rates in the market? So can these institutional investors make enough money by just putting money in the bank? And if the general interest rates are really low, then of course, venture capital as an asset class becomes more attractive, because the assumption would be that the returns of startups are not correlated to the returns of the debt markets. And so that's one function of how easy is it to raise for VC. And then the second function could be, how is the full portfolio of an institutional investor doing? And if the full portfolio is reducing in value because the real estate market is going down or the stock market is going down, that can have an implication on how much money that institutional investor can put into venture capital. So even if you as founders are doing everything right, it may still mean that the VCs have no money to give to you.
So Stefan, a quick question.
Yes.
Actually. Obviously, you know, when COVID hit, a lot of founders were very scared they cannot get money from VCs. But actually, as we know, you know, the VC money is already raised, you know, all that, yes, you know, raised the money. So at least for the short term, like that pie of money is still there. When do you think that VCs are actually going to get hit because of COVID? Because obviously there's a delay, and maybe some platforms will be able to raise, but when do you think the first victims are going to come?
So that's a really good question. And I think the answer is not super clear. I think I've been reading some blog posts, I'm sure you've all seen that, where they said, I mean, the clickbaity headline said that there hasn't been as much of a reduction in deal activity as one would have potentially expected. Now, it means that the people that already had a fund raised in January this year, they have a mandate, and we're going to touch on it in one of the future slides, to invest their money in usually a 5-year period. So there's 5 years where they can choose new startups to invest in, and there's another 5 years where they just don't select new startups, but put money on the winners of those that invested in the first 5 years. And if you are in that 5-year investment period right now as a VC, you don't really need to worry about much, because the money is already there. There are stories that I heard that, and that's another little smaller detail, that those limited partners, they don't transfer their money on day one. They make a commitment to invest, let's say 1 billion in, let's say 10 million in a venture capital fund. And that commitment just means that when the VC makes an investment into a startup, they call the LP, the limited partner, and say, hey, please send us $100,000 now, which is whatever your percentage of the fund as a percentage of the deal. So if the fund makes a $1 million investment and the limited partner has invested 10% of the fund, they would have to do 10% of the round and send the money to the VC, and the VC sends the money to the startup. And I actually heard that there's some limited partners, especially those with a corporate background, that didn't respond to those what's called a capital call. So the VC makes a capital call saying, hey, we made an investment, we just signed the paperwork, limited partners, everyone sent the money next week so we can transfer it onto the startup. And apparently during COVID, some of those limited partners didn't answer the phone, in the sense that they said, sorry, we cannot send you money right now because we have other problems. Of course, it's a breach of the contract, and I don't know what you do with that situation, but bottom line is that the VC doesn't have the money lying around. The VC just has a agreement with limited partners that claim to have the money lying around and will send it when there's an opportunity. But lo and behold, most VCs, sorry?
Is there anything that founders can do? Maybe questions they need to ask in their due diligence, when they're doing with the VC to kind of know or to protect themselves, at least to set expectations? Or
I would say the main thing that's around this that plays into this dynamic is, are you in your investment period as a VC, and do you have money to spend? Because if you're not in your investment period, and instead if you're fundraising yourself and you're just kind of waiting to close your fund, then you're a waste of time to be talked to as a founder, in the sense that VCs that don't have a fund that is actively investing in the investment period, you as a founder don't really need to talk to them. Of course, you want to be creating the relationship and maybe be ready to talk to them in a year from now. But in the sense that if funds are not in the investment period, they wouldn't be the ideal person to talk to. But to come back to this question of COVID, right? So if you've closed your fund, you kind of don't need to worry so much right now as a VC, because you still have a mandate to spend the money over a period of time. And now it gets more tricky, because the 5 years of investment period are 5 years. And some would argue that the world has gone on hold for 6 to 12 months due to COVID. So what do you do if you have 5 years to invest your money, but 1 year you can cut because COVID hit, and maybe another year you can cut because consumers are not spending money, businesses are not buying software. So it could be quite annoying, even if you have the money to invest right now, that you wouldn't want to invest it because the world has slowed down a little bit and business activity has slowed down. Of course, you could argue the other way around, that most venture capital investors are investing in digital technologies, which are now getting a push, and even more companies will be buying even more software, blah, 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 which means that if you have money right now, you may be lucky that you can take more advantage of this further increase in valuations. And I was reading yesterday that apparently, I think it was a German newspaper who wrote, are the valuations in Silicon Valley overheating again? Because apparently the valuations of tech stocks are going up even faster compared to the current situation. I don't know. I think the tricky part is, if you are a VC that is fundraising right now, looking to close a fund, it could be difficult, because the people that are giving you money, the pension funds and the corporates, actually what is missing in this list here of who could be giving money to VCs, it often is businesses that want to have a little bit more access or learn a little bit more about tech. Some of them set up their own fund, and then it's called a corporate venture capital fund, but some of them just give money to other fund managers and are hoping for a monthly call to receive updates on what's happening in the tech world. And those corporates currently probably have very little money to spend on other people to invest on their behalf, because they're probably busy with their own problems right now. And so if you are working with a VC, where in the past, maybe until six months ago, it was pretty cool to say, oh, we have Shell, we have Orange, we have big companies, Vodafone, as corporate investors, and we give you access to these corporates. That may have been cool. Now it's maybe not so cool as a VC to have corporates as investors, because the corporates are really fickle and they get really nervous, and now they probably have big problems. So it might be more difficult for these type of VCs to raise follow-on funding for their next fund. But if they have the money and close the fund now, it's not such a big deal. Let's see. So let's touch a little bit more on the structure of this type of fund. As you can see on the right, in the middle is this green thing, and it's the fund, what people would call the Balderton 8 or the Early Bird Eastern Opportunities 3. So it has usually a number, and that's the generation of the fund, or it could also be the early stage or the growth stage, so the different vehicles. And each vehicle, as you can see, invests into startups. So that vehicle, the Limited Liability Partnership, that's the LLP. So this is a legal entity that buys the shares of the startup. And that legal entity, the Limited Liability Partnership, is controlled by the general partner. And the general partner isn't just the man or the woman that has a business card that says partner on it. It's actually also the name of the entity that is kind of controlling the decisions of the limited liability partnership, the vehicle. Yeah, and that management company basically has a deal with the limited partners and says it's called a limited partnership agreement, the LPA. And in this LPA, you would write down all the rules that the vehicle can invest in. So when crypto startups became interesting, and it wasn't just about investing in the startup, but also in the crypto token, a lot of VCs went into their archive and looked at the LPA, the limited partner agreement, asking, hey, are we allowed to invest into a crypto token, or does the LPA prevent us from doing that? So when you as founders talk to VCs and you have a more, let's say, interesting and more modern type of company with, you know, things that are not super standard, what you need to figure out is whether the LPA allows the VC to invest in your kind of business or your kind of structure. I think it would, if you're more international, it could also be that the LPA prevents the VC to invest in legislations outside, you know, British Virgin Islands and Delaware, Corp C, or a European entity, and not into a crazy, country that no one knows the legal setup and all of that stuff. So the general partner, so the company at the top, they basically convince the limited partners to sign the paperwork of the LPA, and then they create the fund. And as I said, there's this committed money that the limited partners promise to send. And then whenever the general partner, i.e. the team, the associates, the principals, and the partners of the fund find a company they want to invest in, they call up, they do the capital call to the limited partner and say, hey, please send the money now. And then the limited partners send the money to the VC fund entity, and they then invest it and send it to the startup. And of course, the limited partners don't just want to gamble, want the VC people to gamble with their money. So they usually also ask for a minimum GP commitment. And that is the amount of money that the GP, the general partners in the fund, also need to invest. And so as an associate in a fund, you don't need to put down any money. But if you are more senior, you're typically asked to also invest your own money into the fund to kind of make sure the interests are aligned. Okay, any questions so far? No, let's continue. So how do the VCs become rich? Well, the answer is carried interest. The quick thing here is it's called 220, and it's the what people call the classic business model for VCs. And that means that you take 2% management fee and a 20% performance fee. So 2% you charge as a VC to the limited partners. So the limited partners say, I'm going to invest 10 million in the fund. Let's say it's a $100 million fund, and one limited partner takes 10% of that fund. So they put 10 million. Then the 2% management fee means 2% of 10 million. They pay to keep the shop running. So if you think about it, a $100 million fund has a 2% operating cost per year. That's salaries, office, travel, etc. And then there's the performance fees. That is the kicker, so to speak. And that is if the fund returns more money than was invested in, the VCs take a 20% share of that profit. So I think I have an example on the next slide on how to calculate that. But here, just to come back to this point that Visila was making also, that usually VC funds have a 10-year investment time frame. And the first half of that is the investment period. And the second part is the reinvestment period or the holding period. And in that period, you're not making any new deals. So even though the fund is still active and still investing, only in the new investment period will they be looking for new deals. And so what most VCs do is they they start investing, and after 2 years of that 5-year investment period, they start raising a new fund, so that by the time just that the the investment period of the first fund is over, the second new fund already starts. Of course, the cool thing is if you have 2 funds in parallel, you also have twice the amount of management fees. That is why in many funds, the management fees go down when the investment period, the new investment period is over, to kind of reflect that. Now, if we look at an example on how to calculate that interest, if you have a $100 million fund, invest in 10 companies, you know how it goes, 8 go bust, 1 gets sold for 50 million, 1 gets sold at 150 million. Let's quickly think about how could that be possible. So remember, it's a $100 million fund and we invest in 10 companies. So we're not investing 10 million in 10 companies. Why would we not invest that? Well, we would be much smarter if we invest 2 to 3 million in 10 companies. So then we've spent around 20 to 30 million, and take the remaining 70 to 80 million and invest it in those companies that do really well to minimize our dilution, right? Because if you don't keep reinvesting, our percentage ownership of the company goes down. And if we have invested early and have 16% or 12%, it's a privilege as a VC that we are allowed to invest in a later round. So that's why the VC will, let's say, invest 2 to 3 million in initial tickets and then reinvest more later on. So the company that gets sold for 50 million, they've probably invested 15 to 20 million into, and the one that exits for 150 million, so the stake of the VC was worth 150 million, means the entire company needs to be worth almost $1 billion probably for that to make sense. For that, they've probably invested even more, so maybe 20, 30 million. So you have decent multiples on 1 or 2 of those companies in the portfolio, and that means you have 200 million that you can return. And because the investor's given you 100 million in the beginning, the carry gets calculated on these excess returns of 100 million. Now, I think what's interesting is that if you think about it, if you return 100 million, so if you didn't have 2 exits, one with 50 and one with 150, but maybe one with 50 and another one with 50, you still have 2 pretty decent exits, right? Because if you own a stake in a company that's worth 50 million, so if your stake in the company is worth 50 million, then the company needs to be worth hundreds of millions for this to make sense, right? So you have, this VC has 2 exits that get promoted in the press as a $300-400 million exit. They both take home 50 million each, but they've not returned any profit to the investors because the investors gave them 100 in the beginning and they're returning 100, and now it gets even worse after 10 years. So after 10 years, you get back the same amount that you invested in. That's negative interest if you factor in inflation. And it's even worse if you factor in the cost of capital that you could have just put in the stock market at the same time with lower risk. So you see, that's why some VCs have a hurdle rate where they say, hey, you as some limited partners are asking for a hurdle rate, which means that the VC only gets a profit share once a, let's say, fair IRR has been achieved for the investor. And then, you can see how it gets quite complicated. What is a fair minimum return for the investor before the VC gets to participate in a bigger sense? Are there any questions so far? Okay, no questions. So let's continue a little bit more. This is what the typical VC fund team looks like. Yeah? So you have something like an intern analyst at the bottom of the pyramid, and then you have your associates, your investment managers, and then your principals, and your partners, and your managing directors. And I think the interesting part here is that it's not a pyramid in the McKinsey sense, where in like a McKinsey or in a Goldman Sachs or in a big bank or in a consulting firm, you have many junior people and very few people at the top. But in VC, it's often almost more like this. So you have a few partners in the fund who are making the real investment decision, and each of those partners usually makes 4 to 5 deals per fund. So that's why in a typical fund, you have 3, 4 partners. Each partner makes 5 deals. So you have about 15 to 20 deals per fund. And then as you go down, you have between half and 2 people per partner as non-partner investors. So these are your associates, your investment managers, etc. And then you have also finance, operations, and support staff, because it's a little bit of legal work, etc., that has to be done and taken care of. And then, of course, some of the more modern funds like Andreessen Horowitz, they've started with models where they hire a lot of people because they have such large funds that the management fees are significant amount of millions of dollars per year. So then they can hire salespeople, graphic design people, data scientist people, whatever people they're excited about, and then offer those people as help to the startups. For example, doing B2B sales and kind of scaling, helping startups scale. The interesting part here, I believe, is that there's this kind of, glass ceiling between the non-partner and the partner roles. And that's why, in the dynamic, if you talk to venture capital funds as a founder, you need to really understand, are you talking to someone that can make an investment decision? And in this example, it is anyone above the line. Or are you talking to someone that is helping people that make investment decisions with their decision, which is people below the line? Of course, there's many funds that have a different setup where the principals are maybe allowed to write their own checks, what you call it. They can make their own investments without asking for permission from a partner. But in a typical VC fund, it's the partners who have to make the investment decision. And so everyone that is not a partner is helping with making research, doing calls, trying to collect information, but they're not actually allowed to pull the trigger. So you need to figure out who you're talking to. And what it also means is that the people below the dotted line traditionally had no way of becoming a partner, because there was usually this idea that you need to have been a founder or an old man to be a VC partner. Now this is changing a lot. And these days there's a lot of VCs that are really proud that you can have a career as a VC and you start as an analyst and work your way all the way up to the top of the fund. I remember when I worked in venture capital, they told me in the first interview, they said, hey, Stefan, this is not a partner track route. So you can work here for 2 years and then that's it. Then you would go do something else. And we don't have any job for you in 2 years. And I said, okay, fine, that's cool. And that's not the case for every fund anymore. But that is interesting for you as founders to think about relationship building, that most likely people are moving around between funds as they grow their career. So, even if you may only want to be talking to a partner in the funds that you're talking to right now, it's also important to talk to the non-partner people, because they could be moving around to another fund that is more attractive in a few months, and then you have a relationship to that fund. And also the dynamic has changed in some funds, as I said, that you don't have to be a partner necessarily to be writing a check in this day and age. And of course, the notion that you have to be an old man hopefully has changed the mindsets of people right now. But of course, the diversity sadly is still pretty limited. With this career VC movement where more and more people can move up all the way from the bottom of the pyramid to the top, I think that should hopefully also change. Quick thing on the life cycle of a venture capital fund. It's a complicated chart on the right, but it basically starts by top left, raising money from institutional investors. So you as a VC would go and ask the pension funds and the rich individuals and maybe the corporates to give you money for your investment thesis to invest in. And then you go and invest money into companies for the first half of maybe 5 years of your investment period. The second part of that investment period would be to monitor and support your existing portfolio and reinvest in those companies. And then at the end, you try to sell and return the money, sell your shares in the businesses and return the money to your investors. And the interesting bit is that I talked about the 10 years, right? So if you think about it as a VC, if you invest in year 4 of your investment period, if you invest in Spotify, And then it takes 8 years, or let's say, I don't know how long Spotify took in the end, but it takes more than 6 years to sell your shares, then you are in a bit of a problem, because then you are at year 10 of at the end of your life cycle of your VC fund, but the shares in the business may only be at Series B level. So then what the VCs sometimes do, they have these things called fund of funds. Then they are like the recycling team of the venture capital world. So they then come in and buy out they could be buying out the limited partners that want their money back, because the limited partner, the insurance company, may say, hey, the 10 years have passed, I want my money back, which is an uncomfortable situation for the VC, because the VC will say, hey, look, I still have these portfolio companies here that are doing really well, they're growing, but they're not going to the stock market to exit, so we cannot get our money back right now. We could, of course, be trying to sell them, but it's not a good time to sell, maybe. And so I remember very vividly at Wellington Partners, we used to be Spotify investors. And when I was working there, Spotify was valued at 5-6 billion. And Apple Music just came out and started this 3-month free streaming offer, and everyone was really, really scared. And we were like, should we try to sell our shares now, because one of our older funds was at the end of the lifetime. So the investors were saying, hey, you know, like, what's going on? The 10 years have passed. Can we have our money back? Because we want to invest it in new funds or invest it in your next fund. But the time has come, so to speak. And then, of course, how do you really deal with that when you think that you have a winner in your portfolio? Now, thank God, of course, Spotify became a lot more successful than 6 billion. I think it exited eventually at 34 billion. But at the time, nobody knew that. And that can create friction for VCs who are always fundraising for their next venture capital fund if their old portfolio hasn't completely liquidated yet. So when you as founders are building a thing that takes a real long time to build, and you're working with a fund that is reaching the end of the investment period and therefore also reaching the end of their investment fund life cycle in the next, let's say, 5 or 6 years, then the VC will have an incentive to make a quick buck more than anything else, because they want to be returning their money to their investors at the end of the 10-year period or whatever 12-year period it is. And they're then not necessarily aligned anymore with making the most money with your business. And if you, there's a question here. What is the typically expected IRR? Okay, we're going to get to it in a minute. Yeah, so Art asks, what about the carry and what about reinvesting? So when the VC makes an exit, they take the money back in, to my understanding, they take the money back and they distribute the capital once the investment period is over. I remember that at Wellington Partners, we had a super fast exit of a really small, like a company that exited within like a couple of months. And, you know, we had a super small stake in it. And then we received that money back. And I remember us talking about that we cannot reinvest that money. So all the money that comes back has to stay there and cannot be used to invest more, because that is what our limited partner agreement said, but I guess you could design that agreement any way you want. I presume that the money gets immediately sent back to the investors, because there's no point in the VC having $100 million in the bank account. But the VCs that get the 20% carry or carried interest or profit share, that goes into the VC's private bank account, so to speak, as a bonus payment. And then they go buy boats and I don't know, you know, or they set up nice impact initiatives with it, or usually they do angel investing from it. So the the profit share is a personal enrichment mechanism. But of course, the better that profit share looks like, the more successful the original fund was, the more easy it is for the VC to raise a new fund. So they don't need to really be investing that into their own fund. And the other thing that is interesting to notice that, as you can see from the carried interest example, 2% of 100 million is 2 million. 2% of 200 million is 4 million. So the bigger the fund, the more management fees you take. So the bigger the fund, the bigger office you can rent, and the more parties you can host. So the idea of a lot of funds over time growing, like they usually start as a seed fund and then they become a Series A fund and then they become a growth fund. And that is a little bit due to the greed of people that want to, with the success of a seed fund, they go and ask bigger investors for more money. And if they ask for more money, they need to be having bigger funds, and that gives them bigger management fees and that gives them a bigger office. The problem is that, of course, the dynamic changes and you need to be doing different types of deals later on. And you can ask the question whether someone who's good at early stage investing or who's lucky enough to have good early stage investment deals will be as lucky or as smart or as good to be making good Series A or growth stage deals. On this slide, here's kind of some of the things that are new in the last couple of years. So there's VCs are a little bit under pressure from three areas, right? One is the newer Eastern investors who have just incredibly large funds from China and from Japan. I've put some of the logos here. This, of course, makes it harder for VCs to be competing for deals. When some people have a big fund that they need to spend, then that can change the valuations a little bit. Everyone knows the discussion about the SoftBank Vision Fund. And the other thing is that it's also good because it means that you as an early stage investor can find someone that invests in a bigger round in your business, therefore driving the valuation, which is again good for you and good for your portfolio. The second one here is the corporate VC trend. So I think Intel Capital is doing 80 to 90 deals per year, Google Ventures, Qualcomm. So these are mostly tech companies, but they are super active, and that makes it, again, very interesting for normal VCs. You know, how should they be thinking about this? Can they be doing their 220 business model, or do they need to rethink a little bit how they're approaching this? And then I think finally, even more recently, like a few years ago, there was this whole crypto token financing trend. I think right now the trends are all about venture debt. So not buying a stake in the startup as an investor, but loaning the startup money, or doing what's called revenue-based financing, where you do a profit share with the startup. So that for startups, there's different ways of getting money. And so that changes a bit the dynamic on what a lot of VCs are doing. And I think from the guy who started the first venture fund in 1959, whatever, to today, the amount of sophistication and diversification is just incredible. I think we don't need to talk about just kind of 4 ways of how these different funds are now becoming more specialized, with more stage-specific funds, with more geo-specific funds, with more sector focus, more thesis focus. But I want to kind of close with this on the whole real dynamic of a VC fund. Yeah? So I think the first thing to note is the Pareto principle applies. So 80% of the returns come from 20% of the startups. And that's the 9 out of 10 startups fail idea. And if you go and you take that 12% annual return, so increasing your investment by 1.12 per year, and you take that to the power of 10. So you say, over 10 years, I have a 12% annual return increase. Peter, to your question, take a guess what that is. it's a 3x return. So as a VC fund, if you say we 3x'd our portfolio, sorry, we 3x'd the money of our fund, you're only providing a 12% IRR. So 3x sounds like, wow, it's so good. Like we tripled our money in 10 years. But if you think about the sort of idea of an interest rate over 10 years and compound interest, then it's only 12% a year. So Peter, as I said in one of the earlier slides, I don't know if 12% is the real number, but when I did some Googling a few years ago on this and talked to a few people, the number that people say when they do VC, they usually they usually expect a 12% IRR as an LP, which means as a VC, you need to provide a 3x for your portfolio. Now, if you think about only one or two of your investments of your 15 to 20 portfolio doing well, then you need a much more than a 10x for the individual investment, but more like 100x. And I think you could also see that in that video, right, where the individual success needs to be incredibly large for this to work out. So Peter, I think 30 to 40% is wishful thinking, because maybe that's what they want, right? The expectation, but I think the real, if you look at your asset classes, I think the average expectation would be something like 12-15%. Now, when you look at, do VCs actually make money? I hope everyone already knows that they don't. And it's just scary. I mean, the source of this chart that I found on the internet is not clear, so let's not get too excited about it. And of course, because VC is a pretty under the radar asset class, most people don't really talk about their returns. But apparently only 5% of funds return more than 3x. So only 5% of funds have a better than 12% IRR. Yeah, 10% of funds return 2 to 3x, 35% 1 to 2x, and 50% of funds return less than the money was invested. And keep in mind, you also pay management fees. So you need to be really doing a pretty decent job not to lose money for your investors. And here's some data that is from this thing called Cambridge Associates. That's a fund of fund. So some of these investors that invest in VC funds, or that buy out the investment portfolio of the VC fund at the end, if the limited partners want the liquidity, even though the fund hasn't sold all the individual startup investments yet. And there you can see, you can look at this in your own time, and we'll send around the slides afterwards. But you can see that for example, in 1999, the first column, the pooled return, so the average return of all the funds that were started in that year was minus 0.62%. So all the venture funds started in 1999, all of them, even the best ones in that fund of fund that invests in many funds at the same time, they're all losing money. And if you go to 2006, it was an average pooled 10% return. So I think Peter, also to your question, you can see the pooled return in the first column here. And I guess the question is, what is the expectation? What is real? And you're right, Peter, that I think the stock market is 10% on average. But the outliers is, of course, what makes it interesting, right? And I think you can see here in the upper quartile is doing slightly better than the pooled return. But the real winners are a few funds, and the majority of funds is actually just losing money. I think there's one other question that we talked about, and that's kind of that. How is that different between VCs and corporate VCs? And I think if you look at this picture here, the normal VC does this in order to return a more than 3x fund for their investors. So they give them a better than 12% IRR. And a corporate VC may or probably has different objectives. So the corporate fund could be doing this in order to learn about new technologies, in which case the investment return is insignificant. And if you think about a business that makes 20 billion in revenue, and they have a 100 million fund, then even if the fund gets 3x, that means they invest 100 million, they get 300 million out of it. If they do 30 billion in revenue, that's completely insignificant and no one cares if they're returning the money or how much of that they're returning. So depending on what kind of corporate VC you might be talking to, it might be that they are incentivized, like for example, BMW iVentures, which is the corporate VC of BMW, the car maker in Germany. They are famous for having a carry setup, which means the people working there have a real carry and they can be incredibly rich if they invest in good things. The same goes for Deutsche Telekom Capital Partners. And these are the only funds that come to my mind right now that have a carry team setup. Most other corporate VCs are set up like a normal team where people are paid a salary. And it doesn't really matter. They cannot become super rich if their investments do really well. And again, that of course means that the way people think about doing deals is quite different than if the outcome needs to be a financial multiple. And the other interesting thing about corporate VCs is that usually the innovation view of the corporate is that we are losing money because customers are buying less of our traditional products. And so the corporate VC is supposed to find new ways of plugging the revenue gap that is being created in an aging business of the corporate. But the weird thing is that, as you can see, the regular VC game doesn't give you any revenue. It doesn't give you any regular payments. No, it just gives you like a multiple on your invested money after 10 years. So I think that makes it really interesting as a discussion on why the hell are so many corporates interested in making their own corporate venture capital unit? Because, you know, just by getting a 3x return in 10 years, you're not figuring out your digitalization problems or you're not figuring out new business models. But of course, you can use that CVC, that corporate venture capital unit, to maybe discover new technologies or to find new partnerships. So when you're talking to corporate VCs versus normal VCs, super interesting to understand the KPIs and the reasons. Where a normal VC, the main KPI they have is how much money are they returning and when are they returning it. So the sooner they're returning their exit, the better. But a corporate VC probably has plenty of different KPIs. Could be number of pilots initiated, so how many partnerships coming out of those investments. And of course, one of the more negative things about corporate VCs is that when the corporate big boss, when she changes her strategy for the big company, that often means no more venture capital investment for the time being. And then the more dependent you as a founder are of receiving more money from your existing investors, and if those existing investors are corporate VCs, then it might be tricky to receive that money in the future, because the normal VC has a 10-year agreement, and within those 10 years, it's a contract and it's all committed. So it's not going to change. Whereas in a corporate, it could, in theory, change every year. That one year they say we want to be an investor, the next year they say we don't. And so that kind of dynamic of change can be really disruptive for founders.
I think this is a very good point. Just to say that, you know, we so far in this course, our founders have heard on multiple occasions how they're a financial product from a VC standpoint. And I think that's still true. But I think when it comes to CVCs, that's where that model slightly can break down. Because at that point, you know, the CVC is looking for strategic alignment. It's looking for, you know, it's looking for ways to innovate their own corporate agenda and their own products. There was a very interesting chart a few years ago when we were looking into it. Basically, corporate innovation has been slashed by something like 90% in the past 10 to 15 years. And at the same time, all of these corporates are now coming up with their CVCs. So you can argue that, at least some of that money is being channeled into, outsourced teams or, small teams trying to figure out, what innovation is and where the boundaries are for specific, industries. So that's one thing I think to remember.
And I think maybe just so I think if there are any questions, please type them in the chat or raise their hand and come on the camera and let's talk about them. I think my closing thoughts on this topic are, first of all, you need to understand the mindset of the VC, that it's all about a super large exit. Yeah, the J curve means in the beginning it goes down and it's all scary because you're just burning money and you're hoping that eventually that curve of cash flows generated by your startup goes up. It's super risky. That's why they put money in several different companies. They have very few feelings for the individual founders. It's just about finding out who are the 1 or 2 companies that are gonna return outsized returns. And that is not 2x, 3x, 10x. No, it's probably more like 50 or 100x for that one company to be returning so much cash that the VCs become rich and the investors, the LPs, become rich. And if you think that multiple needs to be generated from the point of view that the investor invests in your business. So that means that from when they invest, they need to see that upside. If they invest in you at angel round stage with a 500K valuation, getting a 100x is much easier than when they invest in you at a 50 million valuation. So when they invest in you at a 50 million valuation, like my previous startup that I co-founded, ZenJob, raised 30 million a couple of weeks ago. And it makes me think, okay, well, if they raised 30 million now, the investors that came in at this stage, yeah, they're not looking for 100x return because the business is already stable, growing. It's not super random anymore. Yeah, but still, they probably want a 10x, which means if you assume that the business is valued at maybe 150 or 100 million or 150 million with a 30 million round, because investors typically want 20-25% of the round. That means now these investors think that the business can be sold for $1 billion or more. And then you start to wonder, who are the people that spent 1 billion on a staffing startup? So, the dynamic on, will there be someone buying this thing from when the VC invests with the multiple that this investor needs for their fund to work? That, especially when the ticket sizes become larger, becomes difficult to think about and scary as founders, because sometimes at this point the founder incentives of making a lot of money and building a great business and in general a lot of impact may not be the same as the VC anymore, because the VC just needs to get their financial investment to work at a certain multiple at a certain time. So kind of understanding these things, I think are important to make this conscious decision of taking money from a VC fund. And I think the other 2 things that I talked about, I think I talked about in my last talk also, if you are one investment in that portfolio that is much smaller than all the other investments, then you are not as likely to return the fund as the ones that have the bigger investment ticket. So if you are just a small 100K investment when all the other portfolio investments are $1 million, the VC is not going to spend much time with you, because she's going to be worried that, much more importantly, should she spend time with the 1 million portfolio investment, because that, if that goes 10x, it's going to return the fund, or 100x, whereas the 100K investment needs to be 100x. So kind of understanding where you are in that portfolio. And then of course also this idea on when you negotiate deals, some investors say, in my limited partner agreement, in my LPA, I have agreed to have at least 10 or 15% of stake in each business. So when you're negotiating with a VC on valuation and stuff, you need to think about, okay, well, if these investors need 15% in my business, because for them, only when they own 15% can the multiple make sense for them to return the fund. So these are kind of the reasons why they would be wanting 15% of the fund and not just say, hey, we like your business, whatever it is, we're going to invest some money and hope to get a return. No, it's because their investment logic is kind of driven by these different demands that we talked about today. And that makes them, forces them, so to speak, to be like that. There's some questions coming. So what you can, so the question is, what can you reverse engineer by looking at the VC fund? I think the only thing you can reverse engineer is from the fund size. You can divide the fund size by 15, or 18 or 20, that's usually the amount of investments a fund makes per vehicle. And so each vehicle is one fund that they raise and that runs over 10 years. Yeah. So you can calculate how much money they are investing for each of those companies, but keep in mind, it's not dividing the number of the fund size by the number of portfolio companies, but you need to usually post it on their website, how much is the first investment that they make, and then afterwards they reinvest more in the winners. Yeah. But with this, you can kind of reverse engineer whether your current investment round is a fit for that VC. Because if your current investment round is 500K, but they have a 100 million fund, for them to be part of this round wouldn't make sense because their minimum investment ticket will probably be like 2-3 million. So you can kind of see if it's a fit from the size. And then the other, like the question on where they are in the investment period doesn't really drive the investment size. It just drives the question on should you spend your time talking to them or not? And if they announced the fund more than 4 years ago, the probability of them not really being able to invest is pretty high. Because usually, in my understanding, the fund time frames are 10 years. Sometimes I hear they're 12 years. And then it's usually the investment period is the first 5 years or the first half. But you can ask when people have not announced a new fund for a while, you can ask them, hey, you know, when did you close the fund? What vintage is that? So that's the year when it was closed. And the clock starts ticking. Exactly. And what you can do is that if you are at the end, if you're approaching the end of the investment period, you could assume that a VC is more interested in things that can be sold quickly rather than things that will take a really long time to become valuable. So you could maybe use language like, you know, like in our environment, there have been a lot of transactions with a lot of corporates and competitors. So we expect there to be liquidity opportunities in the next few years. But, you know, I think it's over-engineering. I mean, if they like to invest in you, the VCs will do it, even if you don't tell them that there'll be a sooner opportunity to sell the shares rather than a later one. And ultimately, you know, there's always a way to, if the business is doing well and the investor, the 10-year time frame is finished, you know, you will find someone else to pay money for those shares because there's always someone who wants to participate in the future uptake. So the information on, I unfortunately cannot read Hebrew, I think, so I cannot pronounce the name, but someone asked how we can find out how far they are in the investment period. So as I said in my last talk, there was a website called, or is a website called glassdollar.com, like Glassdoor, but with dollar, glassdollar.com. And Fabian Dudek, founder from Berlin, he tried to build a database of showing how far people are in their fund timeframes. They've kind of, you know, they're not really working on this anymore. So the data I don't think is super up to date anymore, but you can see like a list of investors on their website where you can see based on whether they closed and announced the fund like last year, then they probably have all the money available versus when they closed and announced their fund 6 years ago or 5 years ago, in which case they probably have no money left to invest. So there's some, you know, information that. But as I said also in the last talk, these are the kind of things you need to find out from founders and from other VCs, and kind of through your coffee chats with people to see, oh, rumor on the street has it that these guys are not really investing. You know, yeah, let's not talk to them, kind of thing. Because of course VCs are in the business of and they want to show everyone that they are open for business. I mean, someone did some nice analysis on how every VC after COVID was still open for business. But of course, in fact, not everyone VC was open for business. So I think there's a lot of dynamic around finding out and reading between the lines for this one. So if there are no more questions, you know Innovators Room. Thanks for everyone's time today. I'm around for more questions, if there are any. But thank you already for those that did ask some questions.
Guys, feel free to unmute if you have any questions.
Yes.
I think if there's nothing, thank you, Stefan. This is another really informative talk. I thank you for walking everybody through, you know, the model of VCs, which, you know, everybody thinks they know, but I think there's a lot of gaps. So thank you for filling out the gaps and explaining the CVCs. Yeah, I'll be in touch with some personal thank yous very soon. And for everybody else, we'll see you on Thursday for Pitch Deck Roast.
Thank you, ladies and gentlemen. Have a good day and see you soon.
Thank you.
Bye.
Bye, guys.